Hi everyone, happy Finance Friday. We are so happy to be here. I'm Amy Novakovic and Tamara came back. Yay! Tamara's here with me. Today we're going to talk about several things. In lieu of the news from last week or this week about the Fed chair possibly changing, there was a nomination had, and he's probably going to be the new Fed chair. We want to talk about what investments make you money when interest rates rise, what loses you money when interest rates rise, what you need to do right now, and then also what we're buying. So first things first, I guess, why don't you go ahead and like us on Facebook? I've never said that, I don't think I've came right out and said that. Follow us on Twitter, Nova Wealth Management, at Nova Wealth Management. Management's abbreviated, MGMT. And actually, I just found out that I've never said this either. We have a podcast. You should check out our podcast, the Nova Wealth Show. And we talk about all kinds of things. That's mostly Jim and I interviewing people and going into depth on some other topics.
And also, please share this video with anyone that you think it might be beneficial.
Right. So we're going to get into some specific investments today. We're going to give you some tickers and things like that you can look at, so be ready to check that out. All right, first things first. What do you want to talk about first? Loses money or makes money?
Well, let's first start off by, loses money, because these are the investments that typically are going to be your safe investments in your portfolio.
Right, yeah, and you think of them as safe investments, but we've had, since the early 80s, really, this interest rate trend of they're just slowly coming down, and now we've been at 0%-ish. Well, it's slowly creeping back up now for 8 years, forever. So what has traditionally been safe, aka bonds, may not be so safe moving forward. So let's talk about what loses money. Why don't you first explain the interest rate relationship to bonds? Why they go down when interest rates go up?
Bonds have an inverse relationship with interest rates. So the price of the bond, when interest rates raise, will actually go down.
Yeah. So, like, for instance, if you have a fixed bond paying 4%, right, and the general level of interest rates goes up to 5%, who's going to pay you dollar for dollar for your 4% bond when they can go out and get a new one at 5%? So that pushes the value of your bond down.
So if you needed to sell it at that time when you're in a raising interest rate market, you may have to take less for your bond than what you actually paid for it.
There you go. So that's how you lose money in bonds. So what loses money? So there's actually a ton of total return funds out there. I'm sure you've either seen them or maybe you own them, total return bond funds. You're looking for anything that says intermediate bond fund, long-term bond fund, total return bond fund. These funds will not do well when interest rates rise, okay? If they rise really slowly, like they've kind of been rising, you won't feel it as bad. You'll feel it slowly over time. Like a good example is PIMCO Total Return. Used to have like $290 billion in assets, and now it's like $74 billion. And over the last 5 years, if you pull up a 5-year chart on that fund, it's been slowly coming down. So check out your total return long-term bond funds. And this is huge because this is going to be a difference. We're always talking about, well, how do we help you not lose money, or how do we lessen your risk? But this is a huge swing between you losing money or making money. So, because there's things that you can buy that make money when rates go up. So it's time to make a little bit of a shift, or talk to your advisor about shifting around some of your investments.
And also, real quick, one thing I want to say is long-term bonds are more sensitive to interest rates rising because you're locked into that lower coupon for a longer period of time.
Coupon is the interest rate it pays.
So if you have longer-term bonds and interest rates go up, their prices come down even further and quicker.
Right. So what do you buy in a rising interest rate environment? Hey, Eric. You buy in a rising interest rate environment, there's an asset class called floating rate. There's mutual funds, floating rate mutual funds, there's floating rate ETFs, there's non-traded floating rate portfolios. So you can buy it in whatever form you want, but floating rate bonds, hence the name, the rate floats. So when interest rates go up, your interest rate goes up. And then the demand for that asset class gets better because they're doing well. So you want to look at floating rate bonds. again, in any form, mutual funds, ETFs, or if you already own it, it might be time to take a look and see if you're reinvesting dividends or paying out dividends. It's a good time right now to be reinvesting dividends and buying more shares, before the price rises. I forgot to say another asset class we don't like, an asset class that will also, and I might lose some friends on this opinion here, but munis. Muni bonds. I mean, if you're buying them purely for tax-free interest, and especially if you own like individual muni bonds and when they're going to mature. Muni bonds, by the way, are municipal bonds. They're tax-free interest. They're bonds that pay you tax-free interest. Okay? It's that simple. And a bond, let's back up for some people joining that may not know even what a bond is. A bond is just debt. It's similar to, it's not insured like a CD, but it works like a CD in the fact that you have a maturity date, you have a fixed interest rate, okay, and it's backed by the company that you bought it from. So essentially,
or the government, or the municipality,
right? Thank you. So you're giving money in exchange for an interest rate for a specified period of time. That's all a bond is, okay? So muni bonds. The rates are so low right now. I don't feel like it's very beneficial, unless you're in the highest tax bracket, to have municipal bonds, because the interest rates are so low on the short-term bonds, and on the long-term bonds, they're going to get hit when interest rates go up.
Right.
So take a look at your muni bonds. If you're not in the highest tax bracket, they may not be best for you. Okay, so back to what we like. You want to talk about short duration?
Well, why don't you just retouch on floating rate?
Right, okay, I'll summarize. So we're talking about what makes you money and what loses you money in a rising interest rate environment, okay? So what loses you money is having longer term bonds. So bond funds that say things like total return, intermediate bond fund, long-term bond fund, things like that. I just mentioned municipals might not be so great when interest rates rise, and people love municipals. I don't know what to do. I mean, you want to avoid taxes, obviously, but you do realize the interest rate is lower because they're tax-free. So unless you're in a high tax bracket, it makes no sense. Anyway, what we like, what makes money in a rising interest rate environment. So floating rate bond funds, and you can find mutual funds, ETFs, any type of investment portfolio that has, you can buy them individually too. I probably wouldn't recommend that. I'd recommend buying a portfolio of them. But we like floating rate. It's basically a bond that has an interest rate that floats. So essentially, if you have an equity line, your interest rate goes up.
It's prime plus usually.
It's prime plus, right? Mm-hmm. Floating rate bonds are the same thing. So when rates go up, you get more interest.
How often do they reset the rates in those?
Everyone is different.
Okay.
The one that we use specifically is every 40 days, I think. So there's a little bit of a lag.
But not much.
Not much. And there's also a floor. Like, let's say their floor is 3%. So if we're below the floor, the rate won't move until we get above the floor.
Okay.
Do you know what I mean?
Mm-hmm.
But over the longer term, floating rate makes sense, especially when rates are rising. The other asset class we like when interest rates are rising are short-term corporate bond funds, short-term bond funds.
So what's the difference between the floating rate and the short-term corporate bond funds?
That's a good question. Thanks. The short-term bond funds are fixed rates. So they all pay fixed rates. So imagine like a window, okay? And you have 100 of little window panes, and that's every single one of them is a bond, all right? They're all fixed. All the interest rates are fixed. And you get the average of that interest rate. And even if one were to go bankrupt, if one window gets a rock in it, the whole window is still solid. You're not going to feel it as much. So that's why I recommend that you own a portfolio of something rather than just one bond. Because if that company goes under,
you won't feel it.
Right. Well, you will feel it if it's one company.
If you just own the one, but not in the
portfolio.
Term.
Right. So in the short-term bond fund, they're all fixed rate, but they're very short-term bonds. So the duration might be 2 years. I think on the one that we use,
2.6, isn't it?
And we like a Lord Abbett fund. We like several short-duration funds. Eaton Vance has one too, but this Lord Abbett fund is, I think it's 2 years.
2.2 years.
2.2 years is the duration. So that's very short. So I would say anything under 3 years on the duration is a great fund, yielding anywhere between, and when I say yielding, I mean pays you anywhere between 3 and 4%. So if you're looking for a conservative fund that won't go down when interest rates rise, you got to look at the short-term funds or the floating rate funds. This fund specifically, well, the A shares
moves in price.
The ticker is LALDX, and it varies, but I mean, it's had one down year since '93, and we're completely independent. By the way, we're independent advisors, so we don't care what companies we use. We could switch this opinion in a week if we wanted to, but right now this is a fund that we like with Lord at it. And it's had one down year since 1993 in '08, and it was down 1%. So I mean, with the yield, and especially if you're reinvesting dividends, it's an awesome fund. You used to use this like even years ago at the bank, didn't you?
We used it all the time because it would pay a nice yield. There, of course, you can't get 3 or 4% in a savings account or in a CD, and you know, if the price went up or down, it would go like a penny. It just never moved that much, but it paid a much better yield than we could get in anything savings product-wise.
Right. So it's a great alternative to, you know, any other more aggressive funds if you're looking for a safer fund. And then I also want to mention what you need to do right now. So when interest rates rise, what is action that you need to take? Well, first of all, you have to do an inventory in your portfolios of what you own in bonds and how much of those bonds are longer term. Time to get out of the longer term bonds. All right, so you have two choices. You can put that money into stock, you know, and if you don't want to do that, then you go to something more conservative and you go to like a short duration fund. And if you have the ability, you can find floating rate funds. I don't know that I would really look at high yield too much right now, or preferred stock. Preferred stock is another. High yield, let me back up, so I'm throwing out all these terms. High yield are poor quality. They're not rated very well. But in exchange for that quality risk,
you get a higher yield.
Right. You get a higher rate.
And those can be different terms.
Oh yeah, very. They can be 5 years, they can be 30 years. So that's, again, just, you know, preference, I guess. But I don't know that I would go in that asset class right now. And then preferred stock they work like a bond, but they're actually stock, and they pay a fixed interest rate as well. And they usually pay quarterly. So anything with a fixed interest rate is at risk. Other asset classes that, I was going over what you need to do right now. So you need to go over and take an inventory of your bonds and find out how much is long term, and it's time to reallocate the long term stuff. Either work with your advisor, or if you're on your own, go ahead and just reallocate it into either equities or short-term bonds or cash and money markets. You know, if the market goes down, it's always a good buying opportunity to buy. You need to have some cash.
And if you have any mutual funds in a retirement account and you're in some bonds, take the time to look and see what term those bonds are, what the duration of that fund is.
Right.
You may not be able to tell just by the name.
Yeah, you can look they have what they call fact sheets. You can look right in the fact sheet. It'll say the duration, which is how long the average, you know, hold of the bond is. Well, technically duration is a little more than that, but we'll leave it at that for right now. But you can look online on like a Morningstar or a Yahoo and just look at how long the average duration is, and that will also tell you. It's a great resource. So yeah, that's a great point. If you're in a retirement account, time to look at your long-term bonds.
Yeah, at your fixed portion or your bond portion of your portfolio, and make sure that you're not in the long-term or even intermediate term right now.
I know.
Anything over 5 years.
How do I get a Nova coffee mug? Come on in.
They're for sale for $29.95.
No, they're not. They're really not. What other asset classes are sensitive to interest rates? So real estate. You know, I don't want to say to not own real estate funds, but just think of it like this. When interest rates rise, it's not as easy and it's not as attractive to go out and get a mortgage.
Right.
So people can't get as much home, or they're less likely to just want to go out and buy a home or an investment property or whatever. So it does affect real estate funds. So if you're in real estate funds, if you're in mutual funds or ETFs, real estate, Some real estate funds, be careful because they are debt real estate funds. Again, this is just in like the Morningstar profile or the fact sheet. It'll tell you if it's a debt fund. In the description of the fund, it'll tell you if it's geared towards debt, like lending in real estate, or if it's an equity real estate fund, which just means they go out and buy real estate. So all these things in real estate is affected by interest rates and financials. Banks and financials are affected by interest rates. You want to explain why banks do all right when interest rates rise? Banks make money.
Yeah, well, they get to charge you more money.
Right. While paying you less.
Yes. You won't see your savings accounts go up when the interest rates. They are going to be the last place that you're going to see a rise in interest rates. CDs and savings accounts. It takes a long time to trickle down.
Yeah, because, you know, I have so many clients that say, I have so much money in that bank and they don't pay me anything.
Mm-hmm.
And that's a fact. They're probably not paying you because you might be costing them money. If all you have with them is a savings account, right?
It costs them money.
It costs them money to pay you interest. They're making money on lending, on fees, and or credit cards. If you're not doing any of that, then they're just paying you interest. That's costing them money.
Right.
Deposits cost them money. So banks do well, financials do well when interest rates rise because their spread, we call it a spread. So how much that they are charging people and how much they are paying people mm-hmm. is the spread. Okay, so let's recap real quick, and then I think we can kind of wrap it up. We're trying to go a little quicker here. So you want to summarize what not to buy?
Right now, you need to look at your portfolio and look at your bonds and really maybe think about reallocating out of the long-term bonds mm-hmm. and going into more of the shorter term or the short duration.
Right.
Or not the short duration, the floating rate and the short duration. Yes.
Yeah, both.
And then also look at your holdings for any real estate and think about reallocating those. And then looking at financials. And also, we had talked about how this might be a time to cut back on some of those long-term positions and maybe go into some stocks because stocks typically
do all right when
interest rates go up.
Yeah, so I mean, you have to weigh out the risk and reward, right? You're typically in bonds. Tamara mentioned it in the beginning that you're typically in bonds for the safety.
Right.
And if you're no longer getting that safety piece, and actually the longer term positions, the longer term bonds are now actually a risk to your portfolio, mm-hmm. you might want to consider some equity, depending on what your goal is, and we don't know you, so this is not a recommendation by any means, but it might be, you have to weigh out your risk reward, especially if you are in high yield. Is it worth the risk of a high yield bond fund? Because we just told you they're lower quality bonds, they're lower rated bonds. Is it worth the risk? Is it worth that yield that they're paying you, the interest that they're paying you, 5%, 6%, 7%, is that worth it, or would you be better off in a big company in their stock?
Right.
It's time to just weigh out those. If we're in this tipping point in the economy where interest rates are going to start going up, they're probably raising in December. And again, we're talking about all this because the Fed chair position is going to change from Janet Yellen to Jerome Powell, I think mm-hmm. his name is nominated. And they both have the same philosophy, as far as we know, that interest rates do need to go up.
Right.
They won't say how fast. That's another thing that you have to watch out for. If they raise rates too fast, if they raise rates quicker than what they think they will, the market will have a fit.
Okay.
Watch out for a buying opportunity. If in December they go and raise 0.5% instead of 0.25%, I don't think the market will like that very much.
I don't think it will.
Yeah. So we're kind of preparing for that. So again, LALDX is the ticker of a fund that we like that will be nice and solid and mm-hmm. a good
very
stable, a good safety place for you to go instead of long-term bond funds. Get out of the total return funds. If you mm-hmm. own PIMCO total return, I'd probably get away from it. Sorry, PIMCO. Anything else? I don't think anything else. I think we covered everything. All right. Again, check us out on YouTube, Nova Wealth Management, our podcast, The Nova Wealth Show. Like us on Facebook. Share this video if you liked it, if you think it can help somebody that owns munis, maybe. A lot of people are they're avid muni owners. And help a person out. And then check us out next week. I think we're going to talk about what to do in life events like divorce and death. Right. So we're going to have to get into that on what steps to take next week. All right. Thanks so much for joining and have an awesome weekend.
Bye-bye.